Well, hello. It's very good to be back with you again. I'm Nicholas Bohnsack, President and Head of Portfolio Strategy for Strategas, Baird's investment strategy arm. We wanted to jump right in this week where we left off the last time. So many good questions in the Baird mailbag about asset allocation. And as we discussed, despite some of the headlines, we remain encouraged by the bullish combination of an economy recovering and transitioning towards expansion, aided by the abundant provision of fiscal and monetary policy accommodation. Now, while there are some fundamental areas to keep an eye on, like recent COVID-related softness in the labor market, we believe as the economy strengthens and continues to reopen, we should continue to evidence a material increase in economic activity. Now, of course, as sure as we're talking, this won't happen without a few bumps in the road, but your Baird advisor can help you develop a tactical, risk-adjusted allocation across asset classes that can help inoculate a portfolio against the volatility of an economy in transition and help keep you on track towards your long-term goals. Many of your questions were on two topics in particular, the dollar and gold, and they have a bit to do with each other. As we can see in this chart of the US dollar index, a measure of the greenback's strength relative to its major trading partners, the dollar's value spiked in March on COVID uncertainty before snapping back and then embarking on a 6-month stretch of fairly aggressive weakening. By our lights, this can be attributed in part to the clear, albeit jagged, recovery in the economy and the massive provision of fiscal and monetary spending. $1 trillion here, $1 trillion there, and as they say, soon we'll be talking about real money. And to be sure, a weaker dollar makes U.S. goods and U.S. stocks more attractive, but we need global demand and general business conditions to continue to strengthen, lest the real reason for the weakness be structural, like mounting federal debt and gapping budget deficits, and therefore more concerning. So we should keep an eye on this chart from the OECD of the change in the broad global money supply. You'll note the sharp contrast between the COVID pandemic and the financial crisis a decade ago. This highlights the order of magnitude difference in the provision of fiscal and monetary policy this time around versus the last crisis, and leads us to worry more about inflation. So you know what they say about too much money and too few goods. So for those who watch our tactical allocation strategies, you'll notice we've increased our recommended allocation to gold, just modestly, as a hedge for the potential that inflation picks up later this year, even if it proves transitory. So while it's important to consult with your financial advisor for the impact on your plan, given the likelihood that we'll see more fiscal spending before we conquer COVID, more exposure to the yellow metal could be a prudent shift in positioning. Thank you for all the good questions. Many more on the shifting policy landscape as the Biden administration comes into office, and we'll tackle those and more in the weeks ahead. Until then, remember the Baird team is here to help you however we can. Stay healthy, and we'll see you again soon.